Imagine you're standing in a grocery store and you decide to buy every single brand of apple available. You grab the Galas, the Fujis, the Honeycrisps, and the Granny Smiths. You think to yourself that you are diversifying your fruit intake. But at the end of the day, you are just left with a massive, expensive pile of apples that are going to rot before you can eat them. In the world of investing, we call this the over-diversification trap. Most people have been told that diversification is the only free lunch in finance. They take that advice and run with it until they are holding 20, 30, or even 40 different exchange-traded funds. They think they are being safe. They think they are being sophisticated. But the reality is much harsher. If you are holding 20 ETFs, you are likely just rebuilding the entire stock market, but you are paying 5 times the price for the privilege. You have essentially created a more expensive, more complicated version of a fund you could have bought with a single click. Today, I'm going to show you why your quest for safety in numbers is actually eroding your wealth. We are going to look at the math that proves why a 20 ETF portfolio is a mathematical redundancy. We are going to look at the hidden overlap that makes your diversified portfolio surprisingly fragile. And most importantly, I'm going to show you how to strip away the clutter so your money can actually start working for you instead of just shuffling around in a circle. Before we dive into the spreadsheets and the sector weights, I want to make a deal with you. Investing is one of the few areas in life where doing less actually gets you more. If you can sit through this breakdown, it might be the best return on your time you get all year. Most people spend decades tinkering with their portfolios, chasing the next hot thematic fund, only to find out they would have been wealthier if they had just stayed in bed. If you want to join a community of people who care about the math over the hype, consider hitting that subscribe button. And for those of you who want the deep dive treatment, we have a membership called the Optimizers. You can click the join button below to get priority on your questions and a few other perks. But honestly, the real perk is the clarity we are about to find. We are going to look at why your brokerage account looks like a digital junk drawer and how to turn it back into a wealth-building machine. Let us start with the foundation of the problem, the actual mathematics of risk, and where we all stop getting a benefit from adding new pieces to the puzzle. To understand why 20 ETFs is a mistake, we have to look at what diversification is actually supposed to do. Back in the 50s, Harry Markowitz gave us modern portfolio theory. It sounds fancy, but the core idea is simple. Don't put all your eggs in one basket. If you own one company and that company's CEO gets caught in a scandal, you lose everything. That is what we call unsystematic risk. It is specific to that one company or that one industry. The beauty of diversification is that as you add more companies, that specific risk starts to vanish. By the time you own 50 or 100 different companies across different industries, that CEO scandal doesn't even move the needle on your total net worth. You have diversified away the bad luck of individual stocks. This is where most retail investors get confused. They think that if diversifying away company risk is good, then diversifying away fund risk must be even better. They buy an S&P 500 fund, then a tech fund, then a dividend fund, thinking they are building layers of protection. But there is a second kind of risk that they are completely ignoring: systematic risk. This is market risk. It is inflation, it is interest rates, it is global conflict. No matter how many ETFs you buy, you cannot diversify away the risk of the entire stock market going down. When the S&P 500 drops 20% in a month, your clean energy ETF and your dividend aristocrat ETF are almost certainly going down right along with it. By the time you hit your 5th or 6th broad market fund, you aren't adding safety. You are just adding line items to your statement. There is a very specific mathematical point where adding more stocks stops helping you. Statistical studies have shown that once you reach about 30 to 50 randomly selected stocks, you have already eliminated about 90% of the risk that comes from individual companies. If you move up to 100 stocks, you have basically squeezed out every drop of diversification benefit available in the equity market. Now, let us look at your ETFs. A standard total market ETF like VTI holds over 3,700 stocks. Think about that for a second. In one single ticker symbol, you own nearly every publicly traded company in the United States. You have already achieved the maximum possible diversification for the US stock market. There is no more unsystematic risk left to squeeze out. So, when you decide to add a second ETF, maybe an S&P 500 fund like VOO, what are you actually doing? VOO holds 500 companies that are already inside VTI. You aren't diversifying, you are just double counting. If you then add a Nasdaq ETF like QQQ, you are now triple counting. You have taken a perfectly diversified, mathematically sound portfolio, and you have started to weigh it down with redundant layers. It is like putting on 5 different raincoats. The first one keeps you dry. The next 4 just make it impossible for you to move your arms. Every extra ETF you add past the core market weight is usually just a way to pay more fees for stocks you already own. You aren't getting safer, you are just getting slower and more expensive. Why do we do this to ourselves? If the math says 1 or 2 funds is enough, why does the average investor feel the urge to collect 20? It comes down to a psychological need for control. The market is chaotic and unpredictable. When we log into our brokerage accounts and see only 2 lines, it feels too simple. We feel like we aren't doing enough to protect our future. So, we start looking for gaps. We see a headline about artificial intelligence and we think, I need to be in that. We buy an AI ETF. Then we hear about a recession and buy a low volatility ETF. This gives us a shot of dopamine. It feels like we are being proactive. But in reality, we are suffering from a version of the paradox of choice. Having 20 options doesn't make us better investors. It makes us anxious. When the market dips, we look at those 20 funds and we see 20 different red numbers. We start wondering which one we should sell. We start questioning if our clean energy bet was a mistake. If you only had one total market fund, you would just accept that the market is down and go about your day. But with 20 funds, you have 20 different opportunities to make a mistake. You have 20 different narratives to manage in your head. Complexity is the enemy of execution. The more complicated your portfolio is, the more likely you are to tinker with it at the exact wrong time. Wall Street loves this complexity because it keeps you engaged and paying fees, but your bank account hates it. Here is the protocol I want you to consider. Before you ever add a new fund to your portfolio, you have to ask one question. What does this fund hold that I don't already own in a total market index? If the answer is not much, then you are just adding noise. For the vast majority of people, the mathematical limit of equity diversification is reached with a single, broad market, low-cost index fund. If you want to include the whole world, you might add a second fund for international stocks. That is it. That is the ceiling. Anything beyond that is no longer about diversification. It is about tilting or betting. And if you are going to bet, you need to be honest with yourself that you are no longer just trying to be safe. You are trying to outsmart the aggregate wisdom of every other investor on the planet. Most of the time, when we add that 10th or 20th ETF, we aren't actually betting on new companies. We are just betting that a specific group of companies we already own will do better than the rest. The math shows that over a 20-year period, the chances of you picking the right tilt consistently are incredibly low. So, the protocol is simplicity. Start with the total market. If you feel the urge to add something else, check the overlap first. I think you will find that you are already invited to the party. You don't need to buy a second ticket just to get a different colored wristband. Now, you might be thinking, Tom, I have 20 ETFs, but they are all different. I have a growth fund, a value fund, a tech fund, and a large cap fund. They can't be the same. Well, I hate to be the bearer of bad news, but your portfolio is likely a house of mirrors. In a moment, I'm going to show you a case study of a real investor named Sarah. She thought she was the queen of diversification because she held 5 different specialised funds. But when we looked under the hood, we found out she was basically just all in on 2 companies. If you think you are safe because you have different names on your ETFs, you are missing the biggest hidden risk in modern investing. If you don't understand portfolio overlap, you aren't diversified. You are just concentrated in a very expensive way. Let us look at what happened to Sarah and why your tech ETF is probably just your S&P 500 ETF in a different outfit. Let us talk about Sarah. Sarah is a diligent saver. She reads financial news, she watches the markets, and she wanted to build a bulletproof portfolio. She didn't just buy one fund, she bought 5. She bought the S&P 500, VOO, for stability. She bought the Nasdaq 100, QQQ, because she wanted innovation. She bought a technology sector fund, XLK, to capture the AI boom. She bought a mega-cap growth fund, MGK, for the big winners, and a Russell 1000 growth fund, IWF, to round it out. On her brokerage screen, Sarah sees 5 different tickers. She feels incredibly diversified. She tells her friends she has exposure to growth, tech, large cap, and the broad market. But Sarah is a victim of what we call market cap weighting. See, most popular ETFs don't give every company an equal share of your money. They give the most money to the biggest companies. And right now, a handful of companies are so massive that they dominate almost every index. When Sarah looks under the hood of her 5 funds, she finds a startling reality. Apple and Microsoft are the top 2 holdings in her S&P 500 fund. They are the top 2 in her Nasdaq fund. They are the top 2 in her growth fund. And in her technology fund, those 2 companies alone make up over 40% of the entire ETF. Sarah thinks she has 5 different buckets of money. In reality, she has one giant bucket labelled Apple and Microsoft and 4 tiny little cups labelled everything else. If the tech sector has a bad year, every single one of Sarah's 5 funds is going to crash at the exact same time. She hasn't built a safety net, she has built a magnifying glass. She is paying 5 different management fees to own the exact same basket of 10 companies over and over again. This overlap problem only gets worse as you add more funds. If you move from 5 ETFs to 20, you aren't just double counting, you are creating an impenetrable web of redundancy. Imagine adding a socially responsible or ESG ETF to Sarah's portfolio. You might think that is a different category, but when you look at the top holdings of most ESG funds, who do you see? Apple, Microsoft, and Nvidia. They are seen as clean compared to oil or manufacturing, so they dominate those funds too. What about a dividend appreciation ETF? Surely that is different. Well, guess who has started paying out massive dividends and buying back billions in shares? Big tech. So now your dividend fund is also heavily weighted in the same mega-cap stocks. When you own 20 ETFs, you are essentially closet indexing. This is a term used for funds that claim to be special, but actually just track the market. Except in your case, you are doing it to yourself. You are creating a custom index that is 90% identical to the S&P 500, but you are doing 10 times the work to manage it. You are also likely paying an average expense ratio that is much higher than the 3 basis points you would pay for a simple total market fund. The math of overlap is brutal because it takes away the one thing diversification is supposed to provide: non-correlation. True diversification means owning things that don't move together. If all 20 of your ETFs are weighted by market cap, they are all going to move in lockstep. You have the complexity of 20 funds with the concentration risk of 1. The danger of this overlap isn't just financial, it is behavioural. Overlap creates a false sense of security that can lead to disastrous decisions during a market downturn. When an investor like Sarah sees 20 different funds in her account, she feels protected. She thinks, there is no way all 20 of these could fail. But because she doesn't realise they all hold the same 10 stocks at the top, she is blindsided when they all drop by 30% simultaneously. This shock is what causes panic selling. If you know you own the market, you expect it to go down sometimes. But if you think you've built a diversified masterpiece, you feel betrayed by your own strategy when it fails to protect you. You start looking for someone to blame: the fund managers, the sector, or the system. This psychological blow is much harder to recover from than a simple market dip. Furthermore, this overlap masks how much risk you are actually taking. You might think you only have 5% of your money in Nvidia. But if you own 5 different ETFs that each have a 10% allocation to Nvidia, you actually have a much higher concentration than you realise. You are gambling on a single company's success without even knowing you are at the table. Overlap turns your portfolio into a black box where you don't actually know what you own or how much you are paying for it. Simplicity, on the other hand, provides transparency. When you own 1 or 2 funds, you know exactly who your money is with and exactly what will happen if a certain sector takes a hit. So, how do you fix this without spending 40 hours a week staring at spreadsheets? The protocol is to perform an X-ray analysis on your portfolio. There are plenty of free tools online where you can plug in your ETF tickers and it will show you the combined weight of your underlying holdings. When you do this, I want you to look at your top 10 companies. In a healthy, diversified portfolio, your top 10 holdings shouldn't be so massive that they dictate your entire future. If you find that the same 5 tech giants make up 30 or 40% of your 20 ETF portfolio, you have an overlap problem. The solution is consolidation. You don't need to sell everything tomorrow, but you should stop adding money to the redundant funds. Identify the core fund, the one with the lowest fees and the broadest reach, and start funneling your new capital there. If you are in a tax-advantaged account like an IRA or 401k, you can actually clean this up in about 10 minutes by selling the overlapping funds and moving the balance into your core. In a taxable account, you have to be a bit more strategic about capital gains, but the goal remains the same. Stop paying multiple managers to buy you the same shares of Apple. By narrowing your focus down to a few distinct, non-overlapping asset classes, like US stocks, international stocks, and bonds, you actually achieve more diversification than the person holding 20 different equity ETFs. You are covering more ground with fewer shoes. It is cleaner, it is cheaper, and it is much easier to manage when the market gets bumpy. Remember, the goal of investing isn't to have the most tickers, it is to have the most money at the end of the journey. If you think the overlap is bad, wait until you see the ghost that is haunting your portfolio. This ghost is invisible. It doesn't show up as a red number on your screen, but it can easily steal over $200,000 from you over the course of your career. I am talking about the compounding effect of management fees and factor cancellation. When you own 20 ETFs, you aren't just paying for the stocks, you are paying a small army of fund managers to shuffle those stocks around. Most people ignore a 0.5% fee because it sounds small, but over 30 years, that tiny number grows into a monster that eats your retirement for breakfast. We are going to run the actual numbers on how a complex portfolio effectively guarantees you will underperform a simple one. If you have ever wondered why your returns don't seem to match the headlines, this is likely why. Let us talk about the high cost of trying to be clever. In the world of investing, returns are never guaranteed. The market could go up, it could go sideways, or it could fall off a cliff. But there is one thing that is absolutely 100% guaranteed: the fees you pay. Every dollar you hand over to an ETF provider is a dollar that isn't compounding for you. This is the core reason why 20 ETFs is a mistake. When you buy a broad market fund like VTI or VOO, you are paying an expense ratio of about 0.03%. That is practically free. But when you start adding specialised ETFs, thematic funds like robotics or clean water or smart beta factor funds, the fees jump significantly. These funds often charge 0.40, 0.60, or even 0.95%. The asset managers justify these fees by claiming they are providing expert selection or targeted exposure. But as we just discussed, if you own 20 of these, you are basically just recreating the total market. So, you are essentially buying the total market at a retail price instead of a wholesale price. Imagine going to a store and buying a 24-pack of water for $5. That is the broad market fund. Now imagine buying 24 individual bottles of water for $2 each. You still have 24 bottles of water, but you've paid $48 instead of $5. That is what a 20 ETF portfolio looks like. You have the exact same assets, but you volunteered to pay 10 to 20 times more for them. Wall Street loves this because those small percentages add up to billions in revenue for them. For you, it is just a slow, silent leak in your wealth-building ship. You are working harder to manage the portfolio, taking on more complexity, and guaranteeing that you will lag behind the simple index. Let us look at the actual damage over time. Most people can't wrap their heads around small percentages, so let us use real dollars. Imagine you have $100,000 and you contribute $10,000 a year for 30 years. We will assume the market returns an average of 8%. In scenario A, you are an optimizer. You keep it simple with one total market ETF and an expense ratio of 0.03%. After 30 years, your account grows to roughly $2.12 million. Now, look at scenario B. You are the collector. You have 20 ETFs, some thematic, some factor-based, and your average expense ratio is 0.5%. That still sounds low, right? 0.5%? But after 30 years, your account only grows to $1.91 million. By overcomplicating your portfolio and paying those small fees, you lost $213,000. That is a house. That is a decade of retirement travel. That is the ghost I was talking about. And here is the kicker. You didn't get anything for that money. You didn't get more safety because, as we saw, the overlap means you just owned the same stocks. You didn't get more return because the specialized funds often underperform the broad market after their hype dies down. You essentially paid $200,000 for the privilege of having a messier brokerage statement and more stress. This is why financial literacy is so important. It isn't about picking the next hot stock. It is about stopping the avoidable losses. The person with the boring one-fund portfolio didn't outsmart you with their stock picks. They just outstayed you by not letting fees bleed them dry. Every basis point matters when you have decades of compounding ahead of you. Beyond the direct fees, there is a hidden cost called factor cancellation. This is where your 20 ETFs actually work against each other, leaving you with nothing but a higher bill. Many investors buy growth ETFs because they want high-flying tech stocks, but then they feel nervous, so they also buy value ETFs to balance it out. On the surface, this sounds like smart diversification. But growth and value are just two sides of the same coin. When you buy both in equal amounts, you haven't balanced anything. You've just recreated the blend index, which is exactly what the S&P 500 is. You've paid a premium for a growth label and a premium for a value label, only to have them cancel each other out and leave you with a standard market return. It is like turning your heater and your air conditioner on at the same time. You aren't diversifying your climate, you are just wasting electricity to stay at the same temperature. This happens constantly in 20 ETF portfolios. You buy a momentum ETF that is selling stocks that are dropping, and a value ETF that is buying those same stocks because they are cheap. You are paying two different managers to trade against each other. Your money is just spinning in place, generating commissions for the brokerage and fees for the fund providers, while your net exposure stays exactly the same. This wash effect is a major reason why complex portfolios underperform. You are paying for active tilts that neutralize each other in the aggregate. It is much more efficient and much cheaper to just buy the whole bucket from the start and let the market's internal mechanics handle the balance. The protocol for beating the fee ghost is simple: ruthless consolidation based on cost. If you have multiple ETFs that cover the same ground, keep the cheapest one and ditch the rest. If you have factor funds that are cancelling each other out, consolidate them into a total market fund. You should aim for a weighted average expense ratio of under 0.1%. If your portfolio cost is higher than that, you are likely paying for marketing rather than management. Remember, in investing, you don't get what you pay for. In almost every other area of life, a higher price tag implies better quality. If you pay more for a car, it is usually faster or safer. If you pay more for a meal, it usually tastes better. But in the world of index ETFs, the higher the price, the lower your expected return. The lower the cost, the more of the market's return you get to keep. By moving from 20 ETFs down to 3, you are effectively giving yourself a raise that compounds every single year. You are plugging the leak. This isn't just about saving a few dollars a month, it is about protecting the integrity of your compounding machine. Take a look at your account today. Calculate your weighted average expense ratio. If it is sitting at 0.4 or 0.5% because of all those thematic and niche funds, realize that you are on track to lose hundreds of thousands of dollars to the ghost. Stop the bleeding, simplify the structure, and let the low-cost winners do the heavy lifting for you. We've talked about the math and we've talked about the fees, but we haven't talked about the most valuable asset you have: your time and your sanity. Managing 20 ETFs isn't just a financial burden, it is an administrative nightmare. Have you ever tried to rebalance 20 different funds with different percentage targets? It requires a complex spreadsheet, 3 hours of your Saturday, and a lot of ibuprofen. And the worst part is, the more you tinker with those 20 funds, the more likely you are to fall into the thematic trap. This is where you buy the next big thing at exactly the wrong time, only to watch it underperform while your boring funds carry the day. We are going to look at why thematic ETFs are often wealth destroyers in disguise, and why your urge to be sophisticated is actually your biggest liability. If you feel like your portfolio is a second job that doesn't pay you, stay tuned. We are about to simplify your life. Thematic ETFs are the primary reason people end up with 20 fund portfolios. These are the funds that focus on exciting narratives: artificial intelligence, blockchain, clean energy, space exploration, or even millennial growth. Asset managers are brilliant at marketing. They know that selling a total stock market fund is like selling a bag of flour. It is a commodity with no excitement. To charge higher fees, they have to sell you a story. They package up a few dozen companies related to a hot trend and put a flashy ticker symbol on it. Investors see these and think, AI is definitely the future. I should own this. But there is a massive gap between a technology being the future and an ETF being a good investment. By the time a theme becomes popular enough for a company to launch an ETF, the smart money has already moved in. The stocks are already trading at massive premiums because everyone else also knows AI is the future. You aren't getting in on the ground floor. You are arriving at the party when the cops are already there to shut it down. Research from Morningstar shows that thematic ETFs have some of the worst long-term track records in the industry. They tend to launch at the peak of a hype cycle, attract billions of retail dollars, and then quietly underperform for years as the excitement fades and the high fees eat the returns. Many of these funds don't even survive 10 years. they get closed or merged when the next shiny object comes along. When you add 5 or 6 of these to your portfolio, you aren't diversifying. You are just collecting expensive lottery tickets that have already been drawn. You are dragging down the steady, reliable returns of your core holdings with a collection of high-priced gambles. Even if your thematic bets were good, the administrative cost of managing 20 funds is enough to kill your returns. Portfolio management requires rebalancing. If you decide you want 60% in stocks and 40% in bonds, you have to sell the winners and buy the losers periodically to keep that ratio. With a 3-fund portfolio, this takes 5 minutes. You look at 3 numbers, you do 1 or 2 trades, and you're done. Now, imagine rebalancing 20 ETFs. You have to maintain precise percentages for clean energy, cybersecurity, small cap value, and 15 others. Because these niche sectors move at wildly different speeds, your portfolio will drift out of alignment almost every week. To keep it correct, you have to execute dozens of trades. This creates a massive drag on your performance. Every trade has a bid-ask spread, the difference between the buying and selling price. In niche thematic ETFs, this spread can be quite wide, meaning you lose money every time you move in or out. If you are doing this in a taxable account, every time you sell a winner to rebalance, you are triggering a capital gains tax. You are essentially volunteering to pay the IRS early, which kills the power of compounding. The person with 20 ETFs is constantly fighting a war against their own complexity. They spend their time managing spreadsheets instead of living their lives. And for what? As we've already proven, the aggregate of those 20 funds is almost certainly just going to track the market anyway. You are doing the work of a professional fund manager for a return that you could have gotten by doing absolutely nothing. Complexity is a tax on your time, and in the long run, time is the only thing you can't get more of. The most dangerous part of a 20 ETF portfolio is that it encourages your worst behavioral instincts. We all suffer from recency bias, the belief that whatever happened lately will keep happening. In a consolidated 3-fund portfolio, the noise of individual sectors is hidden. You just see your total balance. But in a 20 ETF portfolio, you see the raw data for every single bet. On any given day, one of those 20 funds is going to be your star performer, and one is going to be your stinker. You look at your cybersecurity ETF that is up 40%, and you feel like a genius. Then you look at your value ETF that is down 5%, and you feel like a fool. The urge to do something becomes overwhelming. You want to sell the loser and double down on the winner. This is the classic mistake of buying high and selling low. You are chasing performance after it has already happened. A complex portfolio gives you too many knobs to turn. When you have 20 funds, you are constantly tempted to tinker, to adjust, and to optimize. But in investing, optimization is often just a fancy word for meddling. The more you touch your portfolio, the more you break the compounding process. The person who succeeds in the long run is usually the one who is the most bored. They don't have enough moving parts to get excited or panicked. By owning 20 ETFs, you have created a high-definition dashboard of your own greed and fear. You have made it impossible to set it and forget it. You've turned a long-term wealth strategy into a stressful hobby that you are paying to participate in. If you really want to simplify your life and save your returns, I want you to adopt the rule of 5%. The math of a 20 ETF portfolio is actually quite funny when you look at the impact of individual funds. If you have 20 funds, each one represents only 5% of your total money. Let us say you have a $50,000 portfolio. That means each ETF has $2,500 in it. Now, imagine one of your thematic bets, say robotics, absolutely explodes and goes up 100% in a year. You feel incredible. You doubled your money. But wait, what did that actually do for you? Your $2,500 became $5,000. your total portfolio went from 50,000 to 52,500. That market-crushing, once-in-a-decade performance only moved your total net worth by 5%. Was it worth the high fees, the overlap, and the rebalancing headache for a 5% bump? Probably not. The rule is this: if a fund doesn't warrant at least a 10% allocation in your portfolio, it shouldn't be there at all. Allocations under 5% are statistical noise. They don't provide enough upside to change your life, but they provide plenty of complexity to ruin your process. If you can't justify putting a significant chunk of your hard-earned money into a specific theme, then you don't actually believe in it. You are just collecting tickers. Consolidate those tiny, meaningless positions into your core holdings. You will find that your portfolio becomes much easier to track, and your performance will likely improve as you stop bleeding fees on bets that don't actually move the needle. So, what is the alternative to the 20 ETF mess? It is a philosophy pioneered by Jack Bogle, the founder of Vanguard, and it is beautifully simple. It is called the three-fund portfolio. The idea is that you can own literally every publicly traded company on Earth and nearly every high-quality bond using just three inexpensive tickers. First, you have a total US stock market ETF. This gives you large-cap, mid-cap, and small-cap companies across every industry in America. Second, you have a total international stock market ETF. This covers developed markets like Europe and Japan, plus emerging markets like China and India. Third, you have a total bond market ETF for stability and income. That's it. With those three funds, you have zero overlap. You have the lowest possible fees, you have maximum diversification, and perhaps most importantly, you have total clarity. You don't have to wonder if you're exposed to AI or healthcare or energy, because you know you own all of them in their exact market proportions. If a new sector emerges and becomes successful, it will naturally become a larger part of your total market fund. You don't have to pick the winner is picked for you by the collective wisdom of the global economy. This approach shifts your focus from playing the market to owning the market. It takes the ego out of the equation. You aren't trying to be a genius, you are just trying to be a participant in the greatest wealth creation engine in human history. The three-fund portfolio is the ultimate optimizer strategy because it provides the highest probability of long-term success with the absolute minimum amount of effort. It is the end of the 20 ETF trap. I know what some of you are thinking. Tom, that sounds boring. I like researching the market. I want to have a little fun with my money. I hear you. If you go from 20 ETFs to 3, you might feel like you've lost your hobby. That is where the core and satellite strategy comes in. This is the financially literate compromise. You take 85 to 90% of your money and put it into the boring, reliable three-fund portfolio. This is your core. It is the money that will fund your retirement, buy your house, and provide for your family. You never touch it, you never tinker with it, and you let it compound in peace. Then, you take the remaining 10% and put it into a satellite account. This is your play money. If you really think cybersecurity is the future, buy one cybersecurity ETF here. If you want to bet on a specific stock, do it here. This structure protects you from yourself. If your satellite bets go to zero, your life doesn't change because 90% of your wealth is safe in the core. If your satellite bets take off, you get a nice bonus. But even in your satellite, keep it limited. Don't let your play money turn into 15 different funds. Pick 2 or 3 high-conviction ideas and own them. This gives you the psychological outlet to play the market without the systemic risk of over-diversification. Most people find that over time, their boring core actually outperforms their exciting satellite anyway. Seeing that happen is the best financial education you can ever get. It proves that simplicity isn't just easier, it is more effective. At the end of the day, investing is about freedom. We invest so that one day we don't have to work. We invest so we can spend time with our families, travel the world, or pursue our passions. If your investment strategy requires you to spend hours every week managing 20 different ETFs, tracking sector rotations, and worrying about overlap, then your money isn't working for you. You are working for your money. The over-diversification trap is a symptom of a world that tries to convince us that complexity equals sophistication. Wall Street wants you to believe that you need a custom-tailored 20-part strategy because that is how they justify their existence. But the data is clear. The most successful investors aren't the ones with the most complicated spreadsheets. They are the ones who can master their own behaviour, keep their costs low, and stay the course for decades. Realising that you don't need 20 ETFs is a form of financial maturity. It is moving past the collector phase and into the optimizer phase. It is realising that the elegance of a simple portfolio is its greatest strength. It is easy to understand, easy to manage, and incredibly difficult to beat. If you take anything away from our talk today, let it be this: you are already diversified enough. You don't need another fund. You don't need another tilt. You just need time, a high savings rate, and the discipline to leave your money alone. Strip away the clutter. Sell the redundancies. Fire the expensive fund managers who are just selling you the S&P 500 in a fancy box. Get back to basics and let the incredible power of global capitalism do the work for you. Keep it simple, keep it cheap, and stay the course. I want to hear from you now. This is the peer review part of the video. How many ETFs are you currently holding in your main brokerage account? Be honest, no judgment here, we've all been there. Are you a collector with 15 or more? Or have you already transitioned into an optimizer with 3 or fewer? Drop your number in the comments and let us know if you've noticed any of the overlap or fee issues we talked about today. Your data helps everyone else realise they aren't alone in this. If you found this breakdown helpful, sharing it with one friend who you know has a messy portfolio is the best way to support the channel. And if you want to see the specific math on the funds I mentioned, or get more direct access to our research, consider becoming a member of the Optimizers. It helps us keep these deep dives ad-free and data-driven. Thank you for spending your most valuable asset, your time, with me today. I am Tom, this is Tom Talks Money, and I will see you in the next one. Go clean up those portfolios, and I'll talk to you soon.